Chapter 1 of the syllabus looks at financial markets and institutions. First of all, we're going to look at the financial markets themselves, looking at the key role they play, of course, in financial intermediation, the means by which capital finds its way from savers, those that have a surplus of capital, and how it finds its way to those that need the capital, firms that might be able to generate a return for investors. We'll look at the role of securities markets themselves in terms of packaging up, really, the claims on corporate and government cash flows for investors. We'll look at the types of financial markets. So this is where we've got our exchanges, of course, on one hand, centralized meeting places for investors, compared to the over-the-counter or OTC markets, whereby trading is carried out bilaterally between two counterparties. We'll also look at the settlement procedures. So within the United Kingdom, the CREST organisation plays a very important role. We'll then look at the role of the UK Listing Authority. This is actually the FCA itself, the Financial Conduct Authority. It's the listing authority in the United Kingdom currently. And look at the role that they play in terms of the requirements for firms listing on the London Stock Exchange. Very importantly, the corporate governance requirements for UK listed firms, very importantly, is managed and controlled by the Financial Reporting Council, the FRC, who lay down the guidelines for best practice of the governance of firms in the United Kingdom. We'll then talk about our international markets. So this is where we're investing abroad, of course, and look at some of the risks there, including foreign exchange risk, for example, and also the different settlement procedures in place in other parts of the world. Finally, we'll look at the principal agent problem. This is where the ownership of a firm is different to the management of it. So here we're looking at the conflicts of interest between the owners of the firm looking for a long-term sustainable management and the role of the managers themselves, where that may be different, of course, in terms of them looking to maximise, for example, their short-term bonuses. So first we're going to look at financial markets themselves. So the financial services industry itself has four principal functions. First of all, playing a role in financial mediation, so where the flow of information and capital between investors, so people with savings, for example, and those looking to use the capital, borrowers and those issuing equity in terms of ownership rights to a firm. So borrowers include companies such as banks, of course. So deposits are placed with banks and the banks then use that capital, of course, to lend into the market. Intermediaries play a key role, such as credit institutions, insurers, pension funds, of course, an important vehicle for pooling capital, which is then used to invest in equities and other securities. The second key role is the pooling and managing of risk. So pooling of investors' capital enables basically greater diversification, really, in terms of the portfolios that can be created for investors. So collective investment schemes, such as mutual funds, enable investors to get a bigger portfolio than they would by investing their funds more directly. Of course, in risk management, insurance has traditionally played a very important role, but more importantly in recent times within the financial markets themselves has been the use of hedging instruments, and particularly there the use of derivatives. Payments and settlement services really run by banks and other institutions to ensure that the payments relating to securities transactions are safely carried out. So a very important role there, of course, in ensuring that transactions are carried out in a safe and secure manner. And finally, portfolio management. So really providing investors with advice in terms of the best place to invest their funds. So the main financial institutions include the central bank. So importantly here, the central bank sets the monetary framework, including of course setting the level of the money supply, and also very importantly looking to control the inflation rate by setting, for example, interest rates for a particular economy. Of course, the central bank in the United Kingdom is the Bank of England. Deposit institutions, importantly, so banks typically here, are accepting money from depositors and then lending it to another party. So again, playing an important role there in financial intermediation. Finally, investment institutions we distinguish from depositors in that they're providing longer-term vehicles really for capitals. So insurance companies, particularly where they're providing life insurance types of products, but also mutual funds, open-ended investment companies, unit trusts and pension funds. Pension funds are in fact the largest type of collective investment scheme. Now governments play important roles, but there's four that we need to identify, particularly for the IMC. One is the production of services that the private sector cannot or will not produce. So this is actually referred to as market failure. So the commercial market is actually not providing these goods and services. So defence, of course, is one role that is importantly played by governments, the provision of law and order, and also the provision of public infrastructure like roads, dams, bridges, that type of thing. Also importantly, other things like the prevention of carbon emissions, taxing environmentally destructive activities, setting standards on food and drugs, also maintaining roads and air safety and quality, etc. All are important roles that the government plays. So production of services that really wouldn't be provided by the private sector. Secondly, the regulation of private firms, really here to protect consumers. Now, of course, the sector that is most closely regulated is in fact the financial sector by the Financial Conduct Authority. But also within the economy more broadly, the government looks to prevent excessive market abuse by promoting competition, particularly preventing cartels from forming. So ensuring that barriers to entry aren't unfair, and also playing an important role in, for example, data protection, and also in protecting the consumer against fraud. Also, the government intervenes in terms of income distribution. So, for example, it sets minimum wages. So, setting a minimum wage above that, which of course the private sector would leave it at if it was left to its own devices. It also makes transfer payments in the form of state pensions. Other benefits such as unemployment benefits are examples of transfer payments. Also, it plays an important role in economic stabilisation, really trying to reduce excessive fluctuations in the economy, which can have adverse effects on income, unemployment and prices. Price levels, of course, we're referring to inflation there. So the monetary policy involves the use of interest rates, increasing interest rates, for example, if the economy is growing too fast in the government's view, that inflation is increasing too rapidly. It can also control the level of the money supply, and the Bank of England is the responsible body for setting that monetary policy in the United Kingdom. The fiscal policy is really determined by the Chancellor of the Exchequer, and this really determines two things. One is the level of taxation on one hand, and on the other hand, it's the level of government spending. So this may well be used in a recession, for example, to stimulate demand in order to try to get the economy to start growing again. And of course, we've seen recently in the 2008-2009 crisis that both in the United Kingdom and in the United States, governments have intervened to bail out banks and other institutions that have run into trouble. Section 2 looks at the role of securities markets in providing liquidity, importantly, as well as price transparency. So liquidity is very important in financial markets. The more liquid a market, then the more confident investors and traders will be to get involved, because the cost of transacting will be significantly less. The types of investments we look at, so assets, as we define them, we have two types. Real assets would be property, gold, commodities, that type of thing. And financial assets are really the claims that we buy through securities markets, for example, on the cash flows generated by companies and indeed the assets that the companies own. Debt claims, such as bonds, for example, are effectively loans that are made by lenders to borrowers, but when we talk about a bond, really, we're talking about a security. So a security is a tradable claim on the debt of a firm or an individual, whereas a loan, really, sitting on a bank's balance sheet is a non-tradable claim. Equities are also called shares in the United Kingdom. They're called stock or common stock in the United States, but called shares in the United Kingdom. And our shareholders, importantly, have an ownership stake in the company that they've invested in. So different, in fact, of course, to our debt claims. A debt claim is lending, an equity investment represents ownership. So securities markets, importantly, are where we're trading these different claims on the assets or cash flows of our firms, or indeed of governments, of course, through government bonds. Money markets, well, really money markets are referencing securities that have a maturity of less than 1 year, and they're really liquidity instruments. Capital markets really are for securities that have a maturity of more than 1 year, which includes equities as well. Equities, in fact, as we'll see later in the programme, are a perpetual investment. It's an ownership stake that we're taking that doesn't have a finite life. So these capital markets, we say, have a maturity of more than 1 year, and here we're looking for a yield on our asset, either through the yield on a bond or indeed the dividend yield on an equity investment. So the functions that securities markets play really are to bring together the buyers and sellers of financial securities. So in the first place, we've got the raising of capital. So this is where a company, for example, comes to the market with an initial public offering, an IPO as it's called, and they're looking for external investors. They're looking for people to come in to take an ownership stake. Or, of course, the company could issue a bond. A bond is a debt instrument that enables them to borrow money, usually more cheaply than a bank loan. The transfer of risk really is what the derivatives markets are concerned with, where we're transferring risk from those parties that don't want to have, for example, interest rate or commodity risk, that those are prepared to bear it. Price discovery is quite an important element, where through the trading on a stock exchange, for example, we're actually finding an equilibrium price through trading. So through the activities of buyers and sellers, then we can see what the equilibrium price of a security is. And very importantly, the creation of liquidity. This is critical, really, that the holders of securities have the ability to sell them when they want to. So this is important, of course, from the point of view of giving investors confidence in the market, that they can actually liquidate their instruments